Hey all, Job here. You might recognize this video that was posted on Recycle Your Money's channel back at the end of April when we mutually interviewed each other. Unfortunately, he had to take this down because he's kind of just refocusing the content on his channel. So this kind of made the cut, unfortunately, but he was cool with me reposting this on my channel. So this is just the interview that he did of me in its entirety. Talked through a bunch of topics about my investing journey, how I got to where I am with this channel and this investing strategy, and yeah, just lots of stuff in between, talking about margin and real estate and all that.
Today we have a really special guest and a fellow YouTuber, FullyInvestedFi. In just a few months, he's built over 4,000 subs on his main channel and over 1,000 subs on a secondary channel. I see that many of you, not all of you, are in the comments and you really like this hybrid approach where you're using some income and some growth to grow your portfolio, using the income side of things to help manage your margin. He always keeps things as transparent as possible with his numbers, which I really respect. At over 35 years old, he has over $500,000 across all of his assets, with the taxable brokerage sitting at over $350,000, pulling in over $4,600 a month in cash flow. And just like me, he's actually living out of his brokerage, not just talking about it theoretically. Let's dive in. Bob, welcome to the channel. Very curious to hear a little bit about your story. Did you have a defining moment in your journey?
Hey man, yeah, thanks for having me on the channel. First things first, defining moment in my journey. So honestly, I kind of got started investing kind of late. I think I got started at 2021, I remember because funnily enough, the defining moment was kind of when all the GME stuff was popping off. Not necessarily that I actually invested into it, but in a weird way that kind of it just made me click in my head. I was like, oh, investing is literally just percentages and math and all the stuff that I'm already kind of inherently have been good at throughout my life. And it just clicked there. From there, as I was kind of talking about with people at work at the time, there was a younger coworker that I was working with. He kind of sherped me a little bit through investing stuff and got me started there. From there, I kind of got started just with ETFs proper. I went through all the way a phase where I was doing a lot of individual and dividend stocks, and then all the way back to ETFs and just growth stuff. And then I started kind of dipping into income in the last few years and kind of really went hard in that. So now I'm kind of at a hybrid approach between growth and high yield income. So just a really hybrid strategy that's kind of built off from where I really started to up till now, really.
Sounds like when you started out, you did a lot of ETFs and growth stocks and just a mixture of stock picking. So at what point did you decide to start introducing margin? When did you learn about margin and what did that look like?
Yeah, margin, I think maybe in the first year or two from when I first started going into investing in 2021, because I, kind of like you, I've always kind of heard in the background of how the rich buy assets and then borrow against them and stuff like that. And I'd hear about that abstractly. And then after when I kind of saw that margin was a thing in brokerage accounts, I was like, oh, I kind of just want to see what that's about for myself. At the time I was Fidelity, I enabled it. And honestly, I at the time, I think I was kind of using it the worst way. I was actually just using it for I think I was offsetting some loans or credit card stuff that I was just putting there and paying that off that way. And until really only in the last year where I've kind of really properly understood it and just kind of going through a lot of people's videos, yours included, Eugene's as well. I really understood it and how I could use it for investing and really leveraging up and kind of getting a good spread and return on that average, And I think the big thing too is that really when I bought my house a couple of years ago in 2022, and kind of understanding how debt can get you a house, and then also just kind of applying those same principles for investing. So it all kind of snowballed from there, and now I'm just a lot more comfortable with it. It's definitely for sure there's some risk there. Yeah, I mean we buy houses all the time, and it's we're comfortable with that big of an investment, and it's not that too different from that in a way,
I very much agree, and it took me a while to realize that. So it's very much similar to you take a bunch of leverage to buy a house. Why wouldn't you do the same thing to amplify your stock returns?
Mm-hmm.
So do you own your own home? I use margin for my down payment for my house actually that I live in. Did you do the same thing?
Honestly, back then I kind of was thinking about it because my portfolio was kind of a decent size back then. And I was just could I just technically take margin loan and do that? And at the time I wasn't as comfortable with it yet. So I didn't quite do that. So I really just kind of made up a pretty sizable down payment at the time. It was 20% of the house. So I actually sold a bunch of stock and then also just had some stock stuff from work at the house back then in 2022. So I owned that. And yeah, that's my only property that I own right now. it's been a big learning experience doing that and getting HELOC against it, and then that's also kind of like another form of tapping the equity and stuff like that. So
I
it's
have
all kind
not
of
got a
playing equity
HELOC
together.
against my home yet, but that's something I'm
Mhm,
very interested in doing in the future. I don't have enough
mhm,
equity yet, but that's a very
mhm.
powerful way to lean on another. I always talk about like you can rob from over here to pay from over here. And that's a
Yep,
nice
yep.
way to be able to get yourself out of trouble if one of us were to over leverage in some way.
No,
So
definitely, and yeah, that's kind of like a backup, and then also just like even just as I've kind of been navigating the layoff in the last couple of months, right? Like the HELOC was kind of like a godsend in that sense, where I was having all those issues with like the unemployment from Washington, so I kind of paid myself my unemployment from my HELOC, and yeah, thankfully I had that, or else I would have been kind of screwed up from the layoff in that sense.
I do want to talk to you about the layoff, but first, I do have a lot of people in my comments that are really liking the hybrid approach. So I would like to hear a little bit about that. So currently, you're generating about $4,600 a month from your portfolio alone, just from
Yep.
dividends. You want to talk to us a little bit about what some of maybe your holdings are, what your approach is? I mean, that's more than some people make per month.
Yeah, I've really adopted like a hybrid approach. I pretty much got started in growth investing, and that was my original plan to just kind of get to my retirement through growth investing. Then eventually sell all my stuff, and then go into kind of like lower yielders, which is funny to say now. Like kind of like but when I came up with this plan was like this was when JEPI and JEPQ were the main things that were there, and weren't nothing else was really out, right? And that was kind of my plan to like reach retirement early at 45, and then kind of transfer all my growth stuff to JEPI and JEPQ at the time. So now there's like even even higher stuff now, and that are still kind of like way higher yielder than that, but
Yeah,
still
like Ulti,
kind of get
right?
in safe
Stuff like
range.
that.
Not quite ulti. I don't know if I'd retire fully on ulti, but like that's a small portion of the portfolio. But like SPY, QQQI, TDAC, TSPY, I think those are like safer yielders that are like pay sensible yield, but are indexed and not crazy 70, 80% yields like ulti, and still
So can
keep
I pause
their.
you for a moment? So I don't know as much about income investing because I'm just full pure growth. So
Yep.
I know you talk JEPI, JEPQ, and I think like you mentioned, those are a little bit lower yield and they
Yep.
keep more of their NAV. So for those who
Mhm.
don't know, NAV erosion means net asset value. And with
Yep.
some income stocks, you lose part of your net value, which is what I don't like about it.
Mhm.
But there's some that keep it very well. It's kind of
Yeah. Yeah.
worded poorly. But for example, QQQI tracks the NASDAQ and it holds its value very well. So if I were to do something like what you do,
Mhm.
QQQI and SPYI are two of the things that I would feel maybe comfortable
Yeah. Those are great
holding in my
options.
portfolio. But you want to talk a little bit about like each of these, like this is a little safer than this. This is like, I guess
Yeah.
what holds its value well, what doesn't hold its value well, what's more speculative and what's a little safer and what pays a more sensible yield.
Yeah, I mean, the general rule of thumb I kind of use for, and you have to do your own due diligence with a lot of this stuff, but the general gist is that like anything between a 10 to 20% range, I feel like is actually like safer than you think, especially when it's kind of more like has to do with like options income and stuff like that because you're generating it that way. Like that was like a normal traditional stock, right? Like if it was like
Yep.
a normal dividend paying stock, that'd be like crazy. And I got started in dividend stocks proper, like SEHD and just a bunch of dividend pairs where it's like anything above 4% would be like ludicrous, right? Once you learn
Like
about the
AT&T,
option stuff.
Verizon, right?
What, sorry?
AT&T, Verizon, SCHD, stuff like that.
Right. I'm a big fan of SEHD, and actually, that's actually like one of the big anchors in my portfolio still, and one that I've held since probably 2021. Anything between the 10 and 20% range. So like SPY, QQI, like you mentioned, are great options from Neos, and also tax efficient. They use 1256 options contracts, so that makes it so that like 60% of the dividends that you get are kind of long-term capital gains, and then 40% are short-term, or it might be vice versa. It keeps it like a lot more tax efficient, and some of it can also be a C, return on capital, which defers your taxes. So like it's technically tax free for that year until your cost basis reaches zero, or like if you ever sell, but ideally maybe you don't even sell, so you don't reach that point. So yeah, a lot of tax efficient ways to kind of still get that income, right, and yeah, not pay as much taxes as you think. And then yeah, T-SPY next up after that, and TDAC, that's kind of like the next level up from SPY IQQI, I'd say, where it's like 14 and 17%. Those are still pretty good, and those use zero DTE options on the indexes. XPay, I'm a big fan of. That one's in the 20% range, but that's, I'd say, is really the top end. If you can kind of get that on like dips, that helps a lot, and you can still get capital gains on top of like your 20% yield a year. But then past when you get to the 20, 30% rangers, so anything like I have Chippy, which I think is in the higher range stuff, but that's like quote unquote a little bit safer given that it like actually holds the underlyings and just holds solid semiconductor companies in that sense.
People talk about Chippy lately, and it tracks something like SMH, I think. And
exactly.
So I don't know what I think about that, to be honest. But
yeah, I mean, it has the same problems. Like if you just want pure growth, you're better off just holding SMH, right? But then if you want kind of like that growth and income, so it'll track it relatively well, but then you're kind of capped a little bit on those upswings. But I've been impressed with it so far. When I did the big rebalancing, when I did my layoff, so anything that's higher yielder from like 30, 40% and more, and like even crazier if you're like in 70, 80% range, like those tend to just have a lot more NAV erosion, right? Just because when you get that dividend, that comes out of your net asset value. So that kind of drops the price of the stock. And then you have much more room to kind of make up by the upswings, right? Something like Ulti, for example, or YMAX or YMAG or whatnot. Those get hit pretty hard because they're 50, 60, 70% yielders sometimes, right? Personally, like I still have some of those, and like I know some people rib on me on that for some when I make some buys in them still. But I kind of I'm not investing in them as much now. I'm kind of focusing more on kind of those anchors that are in the 10 to 20% range. But I am glad that I had them in the end, especially kind of with my layoff that just happened now, just because those kind of serve to kind of help boost my monthly income and have like a relative level to start from. And then now I'm kind of just building up the anchors even more so than those are. I'm just kind of cognizant too that there will be some erosion there. There's kind of the trade-off if you want to be making that much yield, right?
So what does your typical asset allocation look like? So what I mean is, yes, you're hybrid. Do you try to do 60% growth, 40% yield? Or do you try to do 60% yield, 40% growth? What does that look like? And then when you're doing that, do you try to keep the majority of your yield in things that don't have NAV erosion? So maybe like QQQI, or like, do you try to mix it up and do like a percentage in like a little less risky, more risky, and so on?
Pre-layoff, I was kind of doing 60% roughly high yield with every paycheck and roughly 40% in growth. Just want to kind of still be investing in both. When I started the whole process, I actually had a lot more in growth than high yield. So I was kind of bringing those up. So it was about 60-40 split. And then now it's kind of getting closer to actually like 50-50 between all of them. Last year, I was kind of going heavy in like stuff like YMAX and Ulti, but also kind of building up some of those anchors as far as like QQQI and things like that. This year, I'm kind of going a lot heavier on just those anchors. So those 10 to 20% yielders. QQQI,
that makes me happier to hear.
Yeah. T-SPY, TDAC. Every now and then I throw a little bit into Ulti on YMAX and certain dips, but definitely not as much as I was doing last year. But also, I just kind of saw firsthand too, kind of like that erosion as it happens too.
I bet that hurts when you don't have as much income from the outside coming in and you see that NAV erosion.
Right. Definitely, and I think that was a big part of how I rebalanced stuff when the layoff happened. I just wanted to lower a lot of the volatility from the portfolio and kind of preserve NAV better. My initial thought was to actually just go 100% high yield now and just kind of save for high yielders. So anything from the 10 to 20% range. So SPY, QQI, T-SPY, TDAC. And that was kind of just like my realization post layoff, where I just kind of like really wanted to push on the monthly income and replace my salary as much as possible as at this point. Like if I were to get laid off again in like 2-3 years, like kind of want to be at the point where I almost don't need the unemployment. And that's kind of just like a bonus if I get that, I want my portfolio to be at a level where my salary is practically all replaced, at least my net salary.
What does that look like? Is that 10K a month? Is that 8K a month? Or what does that look like for you?
Yeah, so my previous job, I was at roughly 10.8K a month.
Fantastic.
Yeah, that was net. Yeah, so pretty good. And then, so this new job is kind of looking more like 9.8K that I'll be doing a month. But now I actually have like, no, still pretty good. Still amazing. But for this new job, I actually have like a 401k match. I'm contributing 4% pre-tax to that and HSA and stuff like that. So that's why that kind of came down a little bit too. So tons of income coming in, and it's honestly, it just feels great to just be investing that fully and kind of like really paying yourself first in the true sense of the word. When people always say it's like, oh, pay yourself first and invest your stuff first and then pay your bills, but kind of really over indexing on like, just actually investing my full paycheck, right? I was kind of thinking that 100% high yield, but then like, as we were kind of having the upswings in the last couple of weeks, it kind of made me think like, do I really want to not do any growth at all? So I'm kind of maybe walking that back. Maybe I'll do like at least 10, 25%, maybe 20% still in growth, but most of it still in high yield. So just kind of
I gotta say, I have been enjoying being a growth investor the last 2 weeks.
You must be loving it the last couple of weeks.
I went from like 550K total portfolio value to like 680 in like weeks. I just every morning wake up and it's green and I'm like, yes. But since
it's
I started
amazing.
my YouTube, it was just like flat, and I had one person comment one time who's like, "You're like your portfolio hasn't changed at all." I'm like, "Wait,
Yeah,
can you
because
just
everything was
wait?"
going down. Yeah. This is like when you should be buying. You should be buying during these dips
Exactly,
and
exactly.
accumulating. I know I think we've talked about this on Discord and stuff, and it's like I've been saying like since the beginning of this year, like I'm kind of worried that this year might be another kind of 2022 tech downturn situation. But also, it's like that's like
Those are the
honestly a
best
great
years.
opportunity. Yeah, it's the best year to be investing, and like that's really where you can kind of make most of your wealth. So it's like assuming you don't blow up your portfolio, it's like just and you're able to keep putting money. It's like it's a great time to be investing.
It sure is. Quick note, if you're enjoying interviews like this, make sure that you like this video and drop a comment below, letting us know if you want to see Gob or any other guests back on. So let's talk rehypothecation a little bit. You did make a video on it recently. I made a video on it recently. So just so people are aware that if you want to do a hybrid approach, there is something called rehypothecation. And what that means is that when you use margin in a brokerage account, they are able to lend out some of your shares and do what's called payment in lieu of dividends, meaning that you're going to get taxed at an income tax rate for a portion. It could be, if I'm not mistaken, up to all of your dividends, but I have never seen that. For me personally, in my brokerage, it was like 20% of my dividends were taxed at pay in lieu of dividends, meaning that the income rate that I get taxed at, so say 33, 35, whatever percentage that is, your dividends will be taxed at that rate. Many people, the reason they like dividends is because you get taxed very efficiently. So maybe like 15% tax rate, which has less drag on your portfolio, obviously, than when you're getting taxed at, say, like 33% or 35%. That can hurt a lot more than you're prepared for if you don't know that it's coming. So someone like Gob is able to have a bunch of business deductions that maybe you don't have. So just be aware that that's something that could really impact you as far as taxes. So Gob, are you able to share some ways that, I guess, share your thoughts on rehypothecation and how maybe you consider it maybe doesn't really impact you so much because of business deductions? What are some ways that people can maybe keep their tax bill down? And one, I guess before we dive into that, would be one idea that I would be have two separate brokerages, meaning if you're going to use income stocks and margin, one way that you can avoid rehypothecation would be to have those income stocks in their own separate brokerage. Now, the downside to this would be that you can't leverage quite as heavily because you then are moving that cash that you used margin for outside of the brokerage that you have the margin usage in. Therefore, your margin health doesn't, like when you borrow margin, you, me, everybody who does this, since it's in the same brokerage account, it juices up your portfolio value when you buy more shares. So what are your thoughts on this? What are some ways that people can maybe, I wouldn't say avoid taxes, but keep their tax bill down? And how did this come into consideration for you moving forward?
Yeah, no, good point. And also shout out to Margin Mindsets who kind of brought. He was the first person I saw ever talk about that, like, and really read the fine print. And yeah, when he had that video, that was kind of like news to me, and I was like, oh, okay, I need to actually look into this and kind of keep this in mind. Then yeah, I saw it firsthand when I got my tax bill this year and kind of like crunched all my numbers. So I made like roughly 52K of income last year in 2025 from my high yield dividends. And so about half of that ended up being 54% ended up being substitute payments or payment in lieu of dividends. So about half that amount was taxable at I think I was 32% last year. So quite a bit. But like you said, I was able to offset a lot of that through my business deductions. So I have like YouTube side income and kind of like my side gig career income. And with that, you can make a lot of business deductions and things like that to help offset that. I had also margin interest. So any margin interest that you accrue over the year too, that's deductible as well. And I had also some carryover losses from previous years. We were talking about like how I bought my house earlier that year. That was like a downturn year, right? But I ended up selling a bunch of stock to buy the house. So I actually had like a 16K loss that year, unfortunately. But yeah, that ended up being a carryover loss that I've been using pretty much over the last few years, really. And actually, I used the last of it this year because I had quite a bit of gains last year with some rebalancing out of kind of my single stocks with like Microsoft and Apple. So I had a lot of gains there. So that helped offset that. So yeah, I mean, ideally, like our tax code really favors like having a side business and buying a home. So it's like ideally, I know it's not everyone that can kind of do this, but like if you're able to do that, like having those two things will be a boon for your tax bills and really reducing things. Like you can deduct your mortgage interest, if you have a HELOC, you can deduct your interest there if you're improving your house, right? Property taxes, all that good stuff. As far as like that strategy that you're talking about, having the second brokerage account, there's actually quite a few people that have brought that up since I posted that video and since I've seen yours as well too. Definitely a good one. Like if you can kind of stomach it margin wise, like personally, like I haven't quite considered that just because given how much margin I'm using, it's not quite feasible to kind of split my account into that way.
Not worth it because the size of your account, you can grow faster having more leverage. And then with your business deductions, if you don't really get a big tax bill anyway, maybe that might change if you get a big tax bill in the future.
Yeah, that's the thing. Like so far this year, honestly, like I was pleasantly surprised. Like I ended up getting a $4K refund for my taxes. So even despite like the 52K of income I made extra last year, like I didn't like technically, yes, I paid tax on it as in like my refund last year, for example, was actually 12K. So even larger. So like there was an 8K difference there. So that 8K kind of went to paying those taxes for that income. But at the end of the day, I made 52K of income extra last year and then got a refund on top of it. It's like pretty good. So I
actually got a bigger refund than I did because so I'm a real estate agent. So I'm 1099 for that income. I made, I don't know, 60,000 or something like that I didn't pay taxes on during the year, which is, I guess, comparable to the amount that you made in income from your income stocks. And then I got like a $1,500 refund or something like that. Let's talk risk management a little bit. You are a little more leveraged than myself. What does risk management look like for you? So for me, I have lines of credit that I can lean on if I get into trouble, say like a paid off truck, things like that. I don't hedge. People have asked me a lot lately if I hedge. Do you hedge? What does that look like? And what does your risk management look like?
Yeah, not in the traditional sense. Like I did mess with put insurance stuff early on, late last year. But personally, I just didn't like the feeling of kind of like, because like at the end of the day, at least for the US market, like most years the market's green, right? So it just kind of felt bad on those green months that I'm like paying insurance for like those crash months, right?
That's how I feel about it.
Yeah, I didn't feel good like throwing that money away every month. So kind of my approach for that was that I actually started like using the $200 a month that I was going to do for like put insurance. And I started putting that towards like gold income ETFs actually.
Oh, cool.
Just as something that's uncorrelated to the market. And traditionally, like I didn't like doing gold in the past just because like it's not like a cash flowing asset. And then I think like just those income layered ones kind of fixed that in my mind. So kind of get a little bit of both, which I liked personally. And then also like one thing that I did when I rebalanced my stuff after the layoff is that I was kind of looking more into some like long short ETFs such as like CLSC and ORR, which is kind of like more long short on international stocks. And those are nice because they're a lot lower beta and a lot lower volatility compared to like the market. So that kind of helps keep it a little bit more stable compared to like traditional equities, which is nice. So I kind of hedging in that way through kind of like still accumulating assets and still investing in the portfolio versus kind of just like paying for that crash insurance, right? Then kind of like you too, I have my lines of credits outside of the brokerage. I have my HELOC. So I have like all these other sources that like in case of emergency, I can break in case of emergency and temporarily kind of pay down the margin balance, right? I kind of rather do that like, because like you say in your ebook, right? Like money isn't real. It's kind of like all fake when you think about it.
It is.
Like it's just deflating. They just print money at any given whim. And it's like everything's run on debt.
Yeah, it is. Like money is debt. So I did promise everybody that we're going to talk about layoffs. Let's talk about what that looks like for you. What changed for you? So I think that you said that you were a little bit more income focused, but now you're trying to do more 50-50. Is that right?
No, actually the opposite. So I'm kind of thinking that I'm going to go even heavier on income. Just because like, so when the layoff hit in the middle of Feb, so I basically, my portfolio was roughly at like 4.6K per month. So it doesn't quite cover my full 10.8K salary that I was getting, right? Had I gotten paid my unemployment properly, like I would have gotten like $1,152 every week. So that would have been like 4.4K every month. So it actually covered like between the unemployment and my income from my stocks, like that was like about 9K out of the 10.8K, right? From my salary. So I was almost fully covered. So yeah, kind of going through that kind of made me really almost kind of want to double down on the income stuff and like really just try to replace my salary as quick as possible. So kind of like the 10.8K that I was making a month, I just want to reach that as fast as I can. And then from there kind of reassess, like maybe once I reach that point, maybe that is a point where maybe I just start reinvesting all my dividends to just keep boosting that, or maybe even that goes towards growth stocks potentially. And a big thing that I did, as I kind of mentioned, is that like I did a big rebalancing when the layoff happened, just because like as I didn't have as much income coming into the portfolio. So I was still investing like any unemployment checks I got through a stopgap measure that I was doing as far as like paying myself my unemployment check through my HELOC, given the issues I was getting with unemployment. So I just wasn't as comfortable with like the swings the portfolio was having. So that's where I got out of like all my single stocks. I don't have any more single stocks in my portfolio, unless you kind of consider like Bitcoin a single stock in a way, since it's just got a single asset or gold, right? But yeah, I'm fully in ETFs now. Any kind of leveraged ETFs that I kind of dabbled with. So things like WPay, or that's like top W now. And what else did I have that was leverage there? It was kind of like in Misty for a bit too. That's basically leverage play on Bitcoin. Anything that was kind of like margin maintenance, like above 25%, I got rid of them and reinvested into other stuff. So now across the board, like my blended margin maintenance rate is actually 25%, which is great. So it's kind of like the most efficient I can be equity wise and margin buffer wise. And now, like the swings are a lot less crazier in the portfolio. It feels a lot more stable, preserving NAV a lot better. And even just during this last upswing too, has been nice to kind of still capture a good chunk of it despite kind of being hybrid growth and income, you know?
So just before we close out, did I hear you say that you have Bitcoin in the same account that you use margin?
I do, yeah. So
I'm always like,
I know
on my
that's
channel, I'm always like, I will never use cryptocurrencies in the same account that I have margin in.
Yeah, I know it's in one of your rules.
You're out here breaking all my rules, dude.
Yeah, I still have BTCI, so not like Bitcoin proper, so not like the spot Bitcoin ETFs. Bitcoin, but still generating income from it. I've held kind of crypto in all its forms over the years. Like I've held it on like exchanges and kind of got burned that way through like Celsius kind of liquidating and going bankrupt. I've held the spot ETFs, and then at the end with crypto stuff, I'm like, I think given the mass of people that have it, it's like kind of a commodity you can't really ignore personally. So I always like to have like a little percentage of it. So yeah, definitely under 5% in my portfolio is across all my portfolios in it. It's not a big amount by any means. But what I like about the income stuff of it is that because it swings so wildly, I kind of like getting some income from it to help cushion those times where it's kind of really low. But yeah,
I bet. Huge thank you for Gob for coming on today. Make sure to check him out at FullyInvestedFi. I'm going to link his channel in the description below. See you next time.